Welcome to the third installation of our Blackwell Global educational series. In today's tutorial, we will talk about margin trading and swap rate. So how does margin trading work? Margin trading simply means you would only need a relatively smaller amount of money to control a larger amount of money. And in a Forex context, it means that you can buy more than you're able to normally with less. To do that, you will need to open a margin account with a broker like Blackwell Global. In this margin account, you will have a balance based on the amount you have deposited that can be used as margin to open trades. So here is how this works. To open a margin trade, you have to set aside some of the equity in your account as margin. This is based on the margin requirement agreeable between you and the broker. With that margin, you can control a large contract size. Another way of looking at it is like taking a short-term loan from us. You can come up with a small percentage of the contract size and we loan you the rest of it as leverage. Now, let's explain the relationship between the margin requirement and leverage ratio. If you have a higher leverage ratio, it means you have a lower margin requirement to put up with us, and that means the margin that you need to put up is lower. If you have a lower leverage ratio, it means you have a higher margin requirement to put up with us, which means you'll have to put it in a higher margin. Put simply, if you have 200 to 1 leverage, it means that you would have to put up 0.5% as a margin. That would mean that if you wanted to control a contract size that is worth $100,000, you would only have to put 0.5% of it, which is $500. This is how you can control a larger amount of money with a smaller amount of money in the Forex market. This is a potential way of magnifying your profits, because you're only using $500 to control $100,000. In margin trading, you're making profits out of the movements of the $100,000 and not out of the movements of the $500. On a positive outlook, if the $100,000 contract appreciates, then you will make money. If it appreciates by $10,000, you will make $10,000. Let's use the example of the New Zealand dollar against the US dollar to showcase this point. Let's say we use one lot of this currency pair, which is a standard contract size of $100,000 of the base currency, as an example. So at the price of 0.85, you do not need to actually have 85,000 US dollars to trade 100,000 New Zealand dollars. If your margin requirement is 1%, you will only need 850 US dollars to control the 100,000 New Zealand dollar position. However good as it might sound, margin trading magnifies your profits as well as your losses. In the case of losses incurred on an open position, the amount will be deducted from your equity, which is the value of your account. Let's say you have an account balance of $10,000 and you open a position with a margin of $500. Unfortunately, the trade went against your favor and the $100,000 contract becomes only worth $94,000. Your current equity will reflect the loss of $6,000 of the open trade. The amount will only be deducted from your account balance when you close the position. One very important concept to know about this margin trading is the stop out level. This level is triggered when your equity falls below a certain percentage of your margin. At this level, which we close all your open positions, think about this as our mechanism to try and minimize a situation where you would risk losing more money than your initial deposit. As this is a very important level, we have also set a margin call to warn you if your account is close to the stop out level. The concept of margin call spans back from the olden days where the broker would actually give you a call when your account reaches a certain level. Nowadays, notifications are done online. If you are close to the margin call level, you will see that your trade window will start to light up in pink. If you want to continue to hold open positions, you might want to consider depositing more money when this is triggered to prevent a situation where all your open positions are closed, even the profitable ones. So what is the stop out level? Basically, it is 80% of your $850 margin, which is US $680. Meaning if your equity drops to $680, we will close all your open positions. In Blackwell Global, our margin call is set at 120%. So assuming the margin you have with us is $850 US dollars, the margin call will be triggered when your equity falls to $1,020 US dollars. The margin call and stop out level may differ depending on the region you are in. Please check the website in your region or the product disclosure statement given to you for more information. Another aspect of trading that you have to understand is the swap rate. Remember how we said that trading on margin is like taking a loan from the broker? Well, think of the swap rate as the cost of borrowing. Swap rate is basically the difference between the financing cost of holding one asset over the other. Each asset that you hold has an interest rate difference. As we all know, the Australian dollar has the highest interest rate as opposed to the Japanese yen. Japanese yen has the lowest rate. You can check on our website at blackwelltrader.com/forex if you wish to check out interest rates and swap rates. We have learnt previously that if you long a currency, you are borrowing the quote currency to buy the base currency. So in the case of the Australian yen pair, if you long the Aussie yen, you are borrowing the yen to buy the Australian dollar. That would actually mean that you are borrowing a low interest rate currency to buy and hold a currency that has a higher interest rate. So the difference between that is the interest we will be paying into your account each day. We call this a positive swap rate. Conversely, you will have to pay us interest each time you hold with a negative swap rate. For example, if you were to hold a short position in the Aussie yen, in this case you are borrowing a currency with a higher interest rate to buy and hold a currency with a lower interest rate. The swap rate is calculated and settled every single day at 20:59 server time. This will be reflected on the swap column in your trade window, and it will be calculated directly on your rolling profit or losses. It's also worth noting that any open positions held from Wednesday to Thursday on a trade date basis will be charged out 3 times the normal value. The extra payment is to cover the interest that would normally have been charged on Saturday and Sunday when the market is closed. With this, we end the tutorial on margin trading and swap rate. Or keep a lookout on our YouTube channel for new Forex tutorials. To find out more about Blackwell Global, please visit us at www.blackwelltrader.com.